All right, folks, today is Tuesday, August 22nd, and this is one of those rare night updates. Usually I do my videos in the day, but the day got away from me, and it is what it is. Today I want to talk about making a small change to my portfolio allocation. I had alluded to this on the last $1 million portfolio update, which I'll link down below, but it's a small change, and I just kind of want to talk through how I came up with it, why, and how it affects the portfolio. So before we go to the change, let's take a look at the current portfolio allocation. So right now we are in 50% NASDAQ 100, the QQQ, 25% long-term treasuries as represented by TLT, 15% gold represented by GLD, and 10% in REIT, represented by O, Realty Income Corp. Now, the change will be to that last component, the Realty Income Corp, that 10%. And mainly the reason that I want to make the change is that the other three assets in the portfolio are essentially ETFs. That last one, even though it's a REIT, it represents a single company. It's based in San Diego. It's been in operation for a long time. It's a good REIT, it's a good dividend payer, it's a good value play, but there's a lot more risk in it being a single company because single companies can go to zero. And that's kind of what made me think about maybe reallocating that small 10% from a REIT, which is kind of a value stock-like component, to an ETF that is a value type ETF. So let's go ahead and take a look at what the portfolio looks like with the original allocation and what my proposed change would be. So if we go to Portfolio Visualizer and put in the original allocation, so 50% into NASDAQ 100 and then 25% into long-term treasuries, 15% into gold, and then the 10% into Realty Income Corp, the REIT. What we see is that over the last almost 18 years, 17 and a half plus years, this allocation, even though it looks kind of weird, returned 11.35% on an annualized basis. And the max drawdown, which is an important metric, at least for me, is 26.75%. So this is actually pretty good. It basically means that you're getting very good returns, but you're not getting a lot of the drawdowns that you would if you were just in 100% equities. And just to remind everybody, I'm going to put in VTI, which is the total stock market index, and put 100% there just for comparison. So even with 100% in VTI over the same time period, you're getting less on the compounded annual growth rate, but you're getting 51% drawdown. And this basically means that from the top in the portfolio to a trough, a bottom, it can drop by 51%. And for me, that makes my stomach churn. So that's why I came up with this original portfolio allocation that gives really great returns for a lot less risk. So let's talk about this change away from the single company REIT in Realty Income Corp to what my proposal is. So what I propose to do is to do something that's very similar to O, which is kind of a value play. It's a stock, it's equity, but it's not quite total stock market, it's not growth. So what I propose is to do a large cap kind of value, like a dividend type ETF. And the iShares Select Dividend ETF has been around for a long time. So if we were to replace our Realty Income Corp allocation to that, let's see what happens to the portfolio. So if I move that 10% from Realty Income Corp to the Select Dividend ETF, what I see is that over the same time frame, and what's holding this back is the data that's available for the GLD ETF, the gold ETF. But it's still, close to 18 years. I'd like to get more, but it is what it is. So when we scroll down to the metrics, what you see here is that, yes, the return dropped slightly, but so did the max drawdowns. And in fact, on the other metric like Sharpe ratio and Sortino ratio and market correlation, they're very, very similar. I think that this is a very good, less risky allocation that still gives you that return. Because remember, even with 100% stock over the same time frame, you're looking at 9.57% if memory serves. So this is still very good, but standard deviation is less, drawdown is less. So this is what I would propose to change it to. But I have a little twist. I prefer to use a different large cap dividend ETF. So instead of using DVY, which is what I use for the backtest purposes, I propose that we use SCHD. So SCHD is the Schwab US Dividend ETF. It's another large cap value play, but the metric that they use for selecting what goes into their ETF is a bit different than the iShares Dividend ETF. But I didn't choose this originally because the backtest is not very long. It's about, what, 11, 12 years? So let's go ahead and take a look at it. Goes from January 2012 to 2023, so almost 11 years. But if you look at the characteristics of switching it up over this time period to Schwab Dividend ETF, the CAGR, the compounded annual growth rate, actually goes up. It's now at 11.9%, almost 12%. And if you look at the max drawdown, it's very similar, even though the standard deviation is a bit less. But on other metrics like the Sharpe ratio and the Sortino ratio, it does better than my original allocation. Again, market cap correlation is very similar between the two. So this is where I would recommend kind of making the change. If you are just starting out, you can just go into this allocation from the get-go. This is all ETFs. You don't have single company risk. And this is a fine allocation that follows my original principles to get roughly market return or better with less risk. Now, if you're like me and you're already in this allocation, what do we do? Well, what I'm going to do is I'm just going to leave it in Realty Income Corp because it's not a bad allocation at all. What I would do is that over time, as new funds go in, dividends are paid, and I'm rebalancing the portfolio, I will slowly shift out of O into SCHD, but still keeping that overall mix to just 10%, that small component. I think this is going to give you the same characteristics that we're after, good returns, but low risk, and still great play for long-term hold. If we were to look at this just for the year-to-date period, so instead of going back to 2011 or whatever, if we just look at 2023, we can see that both allocations are giving a great return. It was approaching, close to 30% at one point, but the last couple of weeks in August has kind of brought it down. But this is actually very good when you compare it to like the S&P 500 over the 7.5 months that we've had so far. So do I trust this allocation? I do. But like I said, if you're already in Realty Income Corp, stick with it. Just move new money over when you have a chance, and you should be good to go. So here it is, year to date. It's beating out the S&P 500. Not much more to say than that. Anyways, thanks for checking in, and I will see you on the next video. Later.